Welcome to Commercial Real Estate Now, in partnership with CBRE Econometric Advisors and my co-host, Dan Diebel. I'm Carly Iacono. Dan, fantastic to see you again. How's everything?
Very excited to be back here with you this month. We're recording this on the 30th of December, so close to the new year, so close to 2025.
In like 2 days, you mean? Yes.
Yeah, recharge our batteries before we
tomorrow.
Start again in 2 days. Yeah.
Recharge fast. That's the theme. Exactly. Yeah. All right. Well, let's kick off what will be our first episode of 2025, and Happy New Year to everyone listening. Thanks for tuning back in, and we hope it's going to be a great year for you as well. Today's episode is on this really neat concept of retail as the anchor. I personally love this as a title and an idea because I feel like for most of my career, retail has been kind of like the unloved stepchild of commercial real estate, and it is time for that to change. So the concept that retail is the anchor, the focus that makes other asset types come together and work better, have higher returns, etc., is just delightful, frankly. So let's talk about what we mean by retail as an anchor. And before we can do that, I think we got to bring it back to some basics and start with definitions of different retail districts. So a little boring at the beginning, but stick with us. This is the framework that is going to launch this really great episode. So Dan, kick us off with some definitions.
Yeah. So I'll take some steps back. We can either look at retail geographically, which is what we're going to do in the district sense, or we can look at retail grouped by its type. The most often type groupings are set down by ICSC, and that's where we get our labels of power centers, neighborhood centers, community centers, strip centers, malls, lifestyle centers. All of that comes from the ICSC of grouping retail based on characteristics. Today, we're going to talk mainly about retail districts, which is a geographic way of defining retail. So we have our broadest level of, well, not broadest, I guess we could look at retail on a country level, but we go country and then markets and then submarkets. So, the market is typically what we would think of. Portland is a market. San Francisco is a market. New York has many markets within it. Once the next step past market is submarket. And that just gives you a little bit more granularity. And those submarkets can range from being very, very small to very, very large. They typically are smaller as we enter the center of a city and get larger as we exit the city. We kind of try to make sure they cover similar amounts of population to make them comparable. And then one step past submarket is these districts. And these districts are going to be little micro pockets of little micro areas. And I'm not going to say micro pockets of retail because these districts were developed for the Shaping Tomorrow Cities research arm in CBRE, that theme, where they decided on these districts based on the types of offices in these districts. And then they layered hexagons over those districts to represent about a 5-minute walk.
Interesting. So are we limited by demographic density then? I'm assuming we're not going to find all these categories of districts, which you're going to outline for us, everywhere in the country, right? Is this more of a big city and surrounding area, or what? How do we know where we find these different districts?
Yeah, so that's a great question. Again, this is built off of the Shaping Tomorrow Cities report from CBRE. And you can actually go in and see these districts on some interactive maps of the 19, let's say 19 largest cities, 19 largest markets that we cover. So it really is just those 19 markets. And if you want to read more about those markets and the way we define those markets, you can go read the initial report or our follow-up retail report. I don't want to jump too far down that, but yes, they're mainly in larger markets. Now, even smaller markets like Portland certainly has the district types that we will classify here. It's just more that they're concentrated and not spread out across the city. Like most of the vibrant mixed use is in one area.
So I think I just want to pause for a second and note that we're talking today about takeaways on what makes retail successful more than we are on what cities you should invest in today, right? Very different distinction. So today's episode is on understanding the interplay of retail and other asset types, the consumer, and not saying you must be in one of these 19 cities to find a good investment. But as all data sets, right, have to have a start and an end, I think it's important to understand where the data is coming from, which is why we wanted to take a beat and talk about what defined a district. So quick side note, carry on.
Perfect. Okay. So districts are these small units. And then these districts were defined based on office buildings. Now, that could frustrate some researchers is not defining the districts yourself or not defining them based off of the product type. So these districts were not defined using the retail product type, which actually is really nice because then we don't have to worry about any of the other issues that might be plaguing that product type. Let's take malls, for instance. If we were to define districts based off of malls, well, some malls are performing extraordinarily well right now. Absolutely crushing it. If we look at Simon's Returns, they're doing incredibly well. And other malls are doing very, very poorly. So that's a very bifurcated data set then. And then you have to deal with all of these issues of who's doing well, who's doing not well. Do we include them in the data? Do we take them out of the data? Here, we don't have to worry about that. These districts were defined based off of the types of office buildings and amenities that surround them. First, they looked at office buildings, and then they looked at amenities to define these districts. So all we're doing is saying, well, if these districts are defined using office buildings and amenities, how does retail perform when we define districts like that? And that's a very clear and easy strategy to actually see where geographically retail is performing well.
So interesting. Feels like a very different way to categorize areas. I like it. It's unique.
Yeah. And it turns out it's really revealing. So I'm going to go ahead. I'll introduce the 4 types that we'll talk about. And then we can kind of start down the path of talking about some of these. So we have the vibrant mixed use areas. So this has got vibrant residential with the addition of prime office space. Now, vibrant residential has a large residential density with walkable retail, dining, and entertainment. So these vibrant mixed use districts really set the standard for a dynamic district. It has walkable retail, large residential population, availability to dining and entertainment, as well as prime office space. The next one we'll look at is the prime business districts. These are predominantly commercial with prime and trophy office buildings. They have some amount of retail, but not necessarily all of the amenities that a vibrant mixed use would, and they are not close to the residential population necessarily either. Then we have the non-prime business districts, which are just commercial districts with no prime office space. These can be within a city Or sometimes they include these suburban office parks. And if it's not the suburban office parks, oftentimes within a city, they're within the more aged part of the downtown, or the more the part of the downtown that's acquired more wisdom, let's say.
It's a very
And
nice way to
then
put it.
lastly, we have mixed use. Now we're separating mixed use and vibrant mixed use here, and I'll talk about that a little bit more later. But mixed use is a term that's often thrown around a little bit willy-nilly. So here we're going to say these are areas of a mix of office space and housing, and these are commonly at the edges of those commercial districts. So they surround some of these older commercial districts where buildings were rebuilt, changed to multifamily sometimes, and then other amenities were added. Now,
Can you just list those 4 names for us again? Because there was a lot of description in between. So 1, 2, 3, 4.
yep, we've got vibrant mixed use, prime business, mixed use, and non-prime business.
Got it. Thank you.
Perfect.
So which would you like to start with? Are we going district by district, or are we going bigger picture first?
So I'll go bigger picture first.
Okay.
We're going to just talk a little bit about how the downtowns and suburban areas have seen shifts and changed post-pandemic. A lot of this analysis is really revealing when we look at 2019 versus today's standard, and what's happening now, and how consumers have kind of changed their approach and their preferences to see where retail within these districts is performing. Now, those 4 district types are spread out between downtown versus suburban areas. And we've known for a while, we've been tracking the difference between downtowns and suburban areas, since before the pandemic. And currently, availabilities in downtowns are 80 basis points higher than those in non-town, 88 basis points higher than those in non-downtown areas. Now,
are you going to tell us how that compared to pre-pandemic? Was that a shift, or was that always the case, that 88 basis point spread, roughly?
That actually is a shift.
Okay.
Previously, urban retail in downtowns and these central business districts had lower availability, even with
Right.
the much higher rents that they charged. They had lower availability. That switched over post-pandemic.
And is holding, because we're now, 4 years, 5 years past the pandemic. So I don't know, that seems to be less of a trend and more of a consistent factor now.
Yes, it is. It is a consistent factor. And in fact, downtowns, when we classify retail in these ways, and we look at the last quarter, so Q3 of 2024, because we're just about to get Q4 numbers in, and then we'll start working with that. But in Q3, it reached its largest spread of 88 basis points. So the spread between suburban and urban has continued to grow post-pandemic. And this past quarter, Q3, we saw no change in availability in our suburban markets when we define it this way. The entire change in availability of increases was in these downtown CBD markets.
Interesting.
Okay, so we know how it's been proceeding in the downtown versus suburban. Much of the consumers have been spending more time closer to home, which has brought more spending to the suburbs and made retailers kind of focus on the suburbs. What we're talking about today in these districts, in that same report, talks about how the suburbs are outperforming and the clusters in the suburbs are doing well, both in the downtown and suburban areas.
I don't think that's a huge surprise, right, though?
Yeah,
because we've seen that because of work from home and population shifts, right? So that's been ongoing for a little while.
Right.
Okay.
Yeah. That's been going on for a little while. we've seen suffering in these downtown areas with availability, with rents dropping as well, trying to lure retailers back into these urban cores. And until recently, we haven't really seen positive stories for retail in these urban areas because we haven't been looking small enough. The losses have seemed large and the gains haven't seemed as large when you look on an aggregate level of a submarket. But when you dive down into these districts that we've defined, the mixed use, the prime business, the vibrant mixed use, and the non-prime business districts, we get a different story altogether about where these businesses are choosing to locate, what's happening to availability, and rents in these areas.
I love surprises in the data, so I'm ready.
Okay. So what would, I guess, I know that you've already seen this graph. What would you think, the way we've defined these districts, which would you think would perform the best in terms of rental growth?
I think this story forever has been mixed use, right? That's the darling. Put housing and communities right next to the retail, and it's going to perform the best. That would be my guess. I already know the answer, but that would be my guess without having any transparency into the data.
Yeah, I think that the mixed use outperforming would have been most of our assumptions moving into this work. It was certainly my assumption as well, is that the mixed use would outperform. Now,
Exactly.
we can talk about outperformance in a few ways. We can talk about outperformance in terms of rent growth and in terms of availabilities. And oftentimes, as availabilities go down, we see increasing rent growth. But that story can always be more nuanced. So let's start here with how availabilities have been trending across these 4 district types. For vibrant mixed use, we saw retail availability sitting around the 5%, 6% mark pre-pandemic in 2019. After that, so in our most recent data, it was sitting at 5.66%, which is just 3 basis points above its 2019 value. So
Wow.
within
Amazing
these,
how consistent that was. Sorry to interrupt you. That's just crazy that it didn't shift with everything that happened in the last 4 years. It was just right there, steady. It's wild.
yeah, and I know that you're not looking at this graph because I didn't share it with you, but yes, it actually didn't shift. It stays very flat. It has some shifts during the quarters, but it stays very, very flat in these vibrant mixed use areas. Now, mixed use cannot claim the same. It also started around 6% availability in 2019 and has since been climbing and approaching 8% post-pandemic and has ticked up the past 2 quarters as well. So mixed use tells a different story than these vibrant mixed use areas already when we're looking at availabilities.
Very interesting. Okay.
If we
Would not have guessed that.
Yep, I think this is what I love about research is when my assumptions are proven a little bit wrong and then we have to look a little harder and we find even more out. So the last 2 districts, the prime business district and the non-prime business districts, are separated by about 2 basis points or 200 basis points when we're talking about availabilities, with the prime business districts sitting around 4% in 2019, and they're approaching that 5% mark in 2024. Whereas the non-prime business districts saw a decrease in availability from around the 6% to the 5.5% mark.
So hold on. That's fascinating. So you're saying that mixed use is relatively flat, vibrant mixed use, that is, non-vibrant mixed use is ticking up in availability. And then our business districts, which have not been as favored, at least in conversation, clearly the data tells a different story, have been decreasing in availability consistently.
Yes, they did see the business districts also saw the largest pop during the pandemic, which makes a lot of sense.
Right.
They were in these areas that had tougher restrictions and more people in them, which gave more ability to transmit. So more things needed to shut down. All of that makes sense that these business areas, retail around these business areas would suffer during the pandemic. And then it's bounced back quite nicely in terms of availability. Retailers moved back into the most part around these businesses, both in the prime business areas and these non-prime business districts.
Can you comment on pre-pandemic to current on the business districts? How are we doing in terms of availability if we take out the craziness that was the pandemic?
Yeah, we're the non-prime business has a slightly lower availability
than pre-pandemic.
Pre-pandemic, the non-prime business was sitting at around 6%, while the prime business was sitting around the 4% mark.
Okay. So they're really back to those levels, maybe even a little better for non-prime?
Yes. For non-prime, it's a little bit better. For prime, it's a little bit worse, but we'll see that there might be some reasons for that given our analysis around rent growth.
And that brings us right into this point too. I thought you'd never bring it up. Rent growth, because that is what investors really focus on, right? What is the rent growth in the market or sub-market where their asset is located? What is their upside over their hold period? So talk to me and share all the good news that we like to hear on rent growth, and the not good news too. Just share all the news on rent growth.
Yeah. So, when availability goes down and we're in a strong market, we would expect strong rent growth as landlords realize that they have desirable space and they can raise the rents on tenants. When we look at it at this district level, we see an interesting story around that because our outperformer in terms of rental growth here, what we've done is we've looked at the 5-year CAGR from 2019 Q2 to 2024 Q2. And I've done this analysis for Q3 and it doesn't change these lines very much at all. The story still holds. So we're not cherry picking data here or anything like that. It holds based off of a few quarters. As long as we take something pre-pandemic and post-pandemic, these results hold. And what the results are is that retail in these prime business districts, actually outperformed the market. Not only did it outperform the market, it outperformed all other district types in terms of rental growth.
Hold on, let's repeat that because that's the big news of the episode, right? That is your flashy headline today. That the retail rent growth this is not prime or prime business districts.
In prime business districts.
Outperformed even mixed use areas.
Even vibrant mixed use.
Even vibrant mixed use. Even better or even more amazing. I don't know, better or worse, but like fascinating, right?
Right.
That prime office is driving more rent growth than apartment buildings around retail.
Yeah. Now,
that's it. No, I'm just kidding. We'll keep talking, but I think that's a great message. It's so interesting to me.
Hmm. I think yes, I think that this is very fascinating stuff. That the retail around these prime office assets, which a lot of the research that CBRE has put out around the prime business districts has been done by my colleagues at EA and America's research at CBRE, has shown that the prime office assets really have not been suffering as much as the non-prime office assets. So, if these office buildings are not suffering as much, the retail is not suffering as much because they're bringing in foot traffic. Those patterns haven't had to change as much. Now, there's something else going on here kind of mathematically. When we're thinking about rent growth, we're often thinking about percentages. And vibrant mixed use districts rents are 155% higher than those in these prime business districts.
Wow, that is a huge delta there. Could you say that that is part of the reason that rents are growing faster because they have more room to run? Is that part of the
So
story?
rents in these prime business districts have had more room to run
Right.
than in the vibrant mixed use. Now, having said that, if you're looking at the graph, if you've chosen to watch this on YouTube, then you can see the line just below prime business is vibrant mixed use. And that these vibrant mixed use districts have also outperformed the market. And they're really, really close to those prime office districts. Like retail in these vibrant mixed use areas has shown incredible percentage growth in terms of rents, even with that markup over
Wow.
retail rents in the prime business districts. So even with that markup, it's still giving good percentage returns, or percentage returns that outpace the market.
That's amazing, really. And if our viewers are not watching this on YouTube and they can't see this beautiful graph that we have put on the screen, what's the laggard? Tell us what's below market in terms of the districts.
I would have thought it was the non-prime business. I
Me too.
really would have
Seems
thought
logical,
that.
right? Hmm.
Yep, it's non-prime business, but it's not. Non-prime business outperforms the market just barely. Our only district that underperformed the market is mixed use.
Wow.
Yeah.
I think that's amazing. And that could be though, because the rents there are already higher, like we just said, than non-prime business potentially. And there's just not as much runway. There's not as much growth, not as much change in foot traffic as, of course, the vibrant mixed use. So they've kind of hit their max, maybe speculating.
Yes.
But perhaps that's part of the driver.
Yeah. The live work play, or these sometimes they're called live work play when they're mixed use. I should
Right.
stick to mixed use. I fell into that trap that discussing retail often brings, which is that everybody defines these things a little bit differently.
Exactly. That's why I made you start with the definitions, because this could be a whole different conversation, right? If your definition is different.
Yes, absolutely. The mixed use areas do have a premium over the prime office rents as well. So they are already higher by, I don't have that stat in front of me, but it's not much higher. It's within $1 or $2.
Oh,
The
wow. Okay. I would have thought it
mixed
would have
use
been a
rents in terms of
bigger
the prime
spread.
office retail rents. So they're
Yeah.
within $1 or $2 of each other, which means
Okay.
these vibrant mixed use areas are also, 155 times the
Right.
size of live work play. So, the markup on these prime, or on these vibrant mixed use areas in terms of rents is already very high. It was surprising to see that these mixed use areas did not outperform the market, even with their higher rental bases. Now, some of what could be brought against this would be like, oh, well, a lot of the new development has been in these mixed use areas and in these vibrant mixed use areas. They're already starting from a high base. So maybe we wouldn't expect to see as much rental growth.
Right. I don't know that we talked about supply coming online. Is that a piece of this equation?
It is. And this is part of the reason why I like to use our EA rents series at EA, is that it's a repeat rent series. So we construct our rent series based off of multiple observations of the same building or center. And then we extrapolate rents from that series of repeat observations at the suite, building, or center level, which means we are not plagued as much by a new building coming online and bringing that rent average up. The rental growth here is that organic rental growth that we found using our EA rent series. So it's not plagued as much by these new buildings coming online and all offering higher rents. And then suddenly we're saying, oh, well, we're saying mixed use outgrew everything else just because it has a higher base, because a really great mixed use property came online and they're asking a lot for rents. So that's what's really nice about the repeat rent series, is it does away with that development question, because it represents organic rent growth, or sometimes they would call it same store rent growth, or multiple repeated rent growth.
It's such a clean way to look at it. And typically when we look at or hear rent growth talked about in a specific market, not of course through EA, but other data services, let's say, or even in the news, I don't know that that's the case. I've never really considered a brand new building, of course, is going to charge higher rents. And then you might have a misgiving about the market overall because you're not clarifying what you're comparing. So I think that the fact that you're so clean with that data is a huge advantage, because it really does give you clear perspective on the market itself.
Yeah, I totally agree. The question I get the most is, why is your rental growth so different than another shop? Or why does this report say something different than this report? Well, a lot of other shops just take the asking rent and they say, oh, asking rent is up this much. Well, sure, but that's all the asking rents in the market at that time.
Right.
You have to take into account quality of the building and other factors when we're trying to construct a stable rental series that's going to tell us how our rents are going to grow over time organically versus turnovers and being able to raise them to market level, or having to push them down if we're in a bad market. So yeah, I really like it. I think it's the way to go in terms of using rents. And if everybody used EA rents, the questions in my email would be a lot less around why rents are swinging around all over the place, because they're just asking rents. You can ask anything you want.
And that gives even more weight to sort of the conclusions that you drew in this episode, right? Or the highlights that you've brought out, because it is so clear and so clean that we're not saying, okay, maybe there was this brand new flashy building in Austin and it changed the whole market dynamic and we're throwing that in. I think that's very important distinction. So I'm glad we came around to that to clarify the way the data is sourced, because that makes everything you just said much more meaningful, honestly.
Yeah, I agree. I think the research strategy is often important. Oftentimes we see data and we don't know how the researchers got there, and sometimes we can have questions. And especially with something like this, where we see mixed use is the only district type that underperforms the market when we define districts like this.
We're calling it a laggard. just because I think that's so interesting. Mixed use is a
It's the
laggard
only laggard.
behind,
It's not a
right?
leader.
Behind the
Yes.
business districts.
Yeah.
Great.
And
Good.
you could definitely worry about the base effect. We don't have to worry about the base effect of rents being very high or new developments coming online and messing up our statistics. Yeah, it's great. I love this.
So the one category that maybe fits into these districts, maybe it doesn't, but one that I was thinking of is high street retail. Is that different? Is that in here? How do we think about high street, really urban retail, and where is that accounted for in these districts, or is it not? Is it its own animal?
Yeah, so some high street retail falls into some of these districts because these districts are geographically chosen. So,
Right. Not property type chosen, like you said in the
right,
beginning. Okay.
not property type chosen. There is actually in that same report a whole other section around high street retail and kind of retail clusters in general and how they're performing. And high street retail has a similar availability rate as it has had basically its entire life. Availability among high streets, and we're not talking premium high streets. Like, I'm not only talking your single most expensive street in New York or Dallas, or is Rodeo Drive in Los Angeles? It is, right?
I think so.
It's
Probably
outside.
the wrong one to ask, but I'm pretty sure.
Yeah, Beverly Hills, probably. Anyway, I should know that.
Yeah, we both should, but clearly
Yeah.
we don't shop there. So
No,
should
I mean,
still know
my
it.
only interaction with Rodeo Drive is through one of the Mighty Ducks movies. I think it's the one where they're on the Olympic team.
So that's a good source. Yeah.
Yeah,
Great.
exactly.
But we digress.
That's what
Okay.
I'm sourcing it from. Anyway, in the report where we classify high streets, it's these, streets of retail that are service the neighborhood, typically have local tenants in them, or with maybe some, higher up brands sprinkled in there a little bit. But these are the high streets are the centers of a community. Occasionally, they do fall into those vibrant mixed use districts or prime office districts. Rarely do they fall into the non-prime office districts.
Okay.
And occasionally they fell into mixed use, but oftentimes they've already been established. They're not redeveloped. They are an established area with retail focused on that community or focused on tourism.
Got it. Okay. So if they're not squarely in one of the other categories that we've talked about, are there any separate insights that you wanted to share on high street specifically?
Oh boy. I mean, we could go all the way into
Just
high
broad.
streets. I think.
No, just kidding. Another half hour. No, I said you got to stay broad. Can't do another half hour. Just
I know we can't do another half hour.
Just give me a chance to maybe sprinkle in a few little nuggets.
High streets have outperformed in terms of unique visitors post-pandemic. And I think we've seen that through consumers wantingness to have experiences and get out and feel a sense of community again post-pandemic. And also their preferences for luxury spending post-pandemic, where they had a lot of savings built up that they could go buy some fancier goods or splurge on a nicer meal, all amenities that these high streets offer. So I think high streets have bounced back really nicely post-pandemic, despite some suffering that actually turned on pre-pandemic. We actually saw rents declining on high streets starting in 2018. And since then, since the pandemic was, let's say pandemic restrictions were lifted, in Q1 2022, they've seen rental growth and are actually at their highest level in terms of base rents that we've seen them at, except for right before the GFC.
Okay.
They peaked out right before the GFC, which makes a lot of sense.
Right.
And then they came down very rapidly, as much
Right.
of retail rents did post GFC.
That was a while ago. Yeah.
Yeah.
Yeah. That's a whole nother show to compare things historically that far back, but interesting that they're back to almost peak levels.
Mm-hmm.
Good,
Yeah.
good to hear. Well, I loved, Dan, all of these insights on the different districts and how retail really has a core place as its anchor. And I think we could go in further to some of the other asset types that benefit from being around strong retail, but we're going to keep it focused on retail today and not touch on office and multifamily as it relates to the retail strength. But I think what we did cover based on the districts and how rents are growing and availability has been fascinating. So really appreciate all of your time. Anything as a concluding thought that you wanted to share today?
Yeah, the anchor of a boat is just part of the boat, and it keeps the boat in place. And if we're thinking about retail as an anchor, then it's the anchor that's providing the amenities that make people either want to live in your multifamily development or head to your office space.
So true. So basically, it all starts with retail. I think that's just a good lesson for everyone listening to remember. It is the
Yes.
core. Dan, this has been fun. Thank you for all of these great bits of knowledge and things that you shared today. We really appreciate it. And to everyone listening, that was Commercial Real Estate Now. We're so happy you joined us, and we will see you again very soon. Happy New Year, everyone.
Happy New Year. Thank you so much, Carly.